And today's topic is going to be something that's very common, and it's something that I've been talking about a lot more lately, and it's called liquidity. Now, when we get into the chart, and after the few examples that I give, you should be able to spot a liquidity setup. You should be able to jump in on these liquidity grabs, and hopefully it'll just boost your confidence as a trader. So first and foremost, before you get into your trades, you do want to check the news and just really see what's going on, because this is going to help you create a bias and establish what you're going to do in the market. So it's Friday. We know the market is going to be closing today at 5 p.m. and we don't see any red folders on Forex Factory. Now, I haven't talked about this in a while, but if you are interested, you can check out any of my trading checklist videos. But the folders are color coded to let you know how impactful the news is going to be to your trading decision. Now, typically, if you see a yellow folder, that means that things are fine, they're typical, it's average news. When you see an orange folder, it's something that can really affect the market, or something that they're going to say is going to affect the market. So you may find yourself getting spiked out or taken out of trades more often than not. And if you see a red folder, I just scroll down to Tuesday. It's just letting you know that this is going to be some high impact news. So you're more likely to see a lot more volatility and movement in the market. So, and a gray folder, just for disclaimer, just means that there is a bank holiday. So those markets will be closed, or if they intersect with another pair and those markets are open, they'll just be moving extremely slow. So we can look and see that the time is around 12:28 p.m. on a Friday, and we don't have any news that would severely impact what we're going to do. So we're good to go. Now, the website that I like to take my trade analysis on is called tradingview.com. TradingView is an amazing place to analyze the markets. It's an amazing place to get trade ideas, interact with other traders, and then just overall really see what's going on before you take the next leap. Now, this is a free website that anyone can access, and they do have a paid version as well. But as a beginner and as you're learning, the free version should be just fine. So the first thing you're going to want to do is select what asset you're actually going to be trading. And for the purpose of my trainings, I like to focus on Euro USD. But you do have the option to select any of these stocks, futures, other Forex currency pairs, cryptocurrencies, indices, bond, and even straight up economy options, right? So we're just going to start with Euro USD, and we're going to click launch chart, because this should take us into the bigger chart. Now on my chart, I have two indicators that are just going to give me more insight into the price. And these are the 50 EMA and the 20 EMA, which you can see represented by these two lines here. At the bottom of my chart, you'll also notice that I have the MOM, or the momentum indicator, which is just going to give me a little bit more insight into how strong a current trend is. Right now, just a little tip or a gem. If you are looking for a simple strategy, this is what I've been using these days to get into my trades. And it has been pretty profitable. But trading is different for every person. It may not work for you, or you may already have indicators that you like. And if that's the case, stick to those, because you don't want to confuse yourself. So simply put, the EMAs stand for exponential moving averages, and this just pretty much lets you know the trend or direction that the market is going. So if you find your candles, right, or price snapshots, which are represented by either these red or green bars below the EMAs, it's letting you know that price is below average and it will continue to sell. So for example, we can see that price, if we were to start here and to look here, we can see that price continued to drop because it was under both EMAs. Now, vice versa, if you see that the candles are forming above both of the EMAs, right, that's going to let you know that there's a buying trend as price is going to continue to go higher. So for example, we have the candles above both of the EMAs here, and then we can see that price actually continued to go up. So it's a really great, simple way to know what's going on in the market. And when you combine it with the MOM, or the momentum indicator, it does, again, give you more insight into what's going to happen. So simply put, you'll see this dotted line right here on your momentum indicator. And to go from just using indicators to make it a strategy, this is how we would use them together. I'm just trying to get to a place where we can see both. All right, so this is how we would use them together. If you see, sorry, I need a better example. I'm just trying to get to a place where you can see both things at one time before we actually get into the lesson. All right, so here's a really great example where we can see both. So if you are thinking about taking a trade idea, you want to make sure if you're looking for a sell, you want to see that your candles are below both EMAs, like we can see right here, right? And then you also want to see that the MOM indicator is below the dotted line, which we can see right here. So that is what made this a great sell opportunity. And you can just get a vertical line to back that up. So simply put, if you're looking for a sell with this strategy, you want to see your candle falling below both EMAs, and you want to see that the momentum indicator is also below the dotted line. Now, vice versa for a buy, if you're looking for a buy opportunity, you're going to want to see that both candles are above the EMAs, as we can see right here, and price will continue to go up. And also the momentum indicator should be above the blue dotted line, which we can see here. And if we get a vertical line, we can see that this would have been a great place to enter. And then the market actually continued to go up for some time. So now that I've explained what I have on my chart, we're actually going to be talking a little bit more about liquidity. And this is only going to add to increasing your confidence for when you get into your trades. So first and foremost, the easiest way to explain liquidity is simply liquidity is, and let me just take off these indicators so we can focus on the naked chart. But you guys can always turn them on or turn them off or hide them as you need it. So first and foremost, liquidity can just be described as the simplest way to put it, it's a place where money is sitting in the market, right? You'll notice that you'll always see, no matter what's happening in the market, you'll always see that the market is either going up, right? Or it's going down, right? It can be going up or it can go down. It can go up or it can go down. And you'll also notice that whenever the market starts to hit certain areas, right? For example, the market was going up, right? Then we see the market came back down. And when it got to this area, it was having a hard time getting lower than any of this. And this will be considered liquidity, right? These wicks will be considered liquidity, and that's the easiest way to recognize them. If you see a collection of wicks that are gathering in an area, this can signify that the market may be about to turn around and go the other way. So for example, we see that price was trying to get lower and lower and lower and lower. Eventually, after a few rejections, it'll typically be 3 to 4 rejections, the market will turn around and go the other way, right? Now, the same thing can happen if you're looking for a sell, right? You'll see, let's look at these wicks right here. You'll see that the market was going up and it's having, well, the market was going up, right? And then it had a hard time getting any higher. So it dropped. It was going up. And we see every single time the market seems to get stuck in this area. Now, when you see this liquidity at the top, this is letting you know that the market most likely is going to turn around for a sell. And then look, we have liquidity at the bottom, and then we have the market going up. We have liquidity at the top. We have the market going down. So this will literally continue to happen over and over and over again. But it's really important to know this information. So when you are setting your stop losses and take profits, you'll know when to enter and when to get out of the trade. Now, something to understand about this liquidity and about these wicks is that the market will always purposely try to take other people out by canceling out the previous highest high or the previous lowest low. And I'm going to explain what I mean by that. Now, let's just focus on this entire section right here, right? This entire section that I am circling with my mouse. So we can see, again, that the market was on a small little uptrend, right? We can see that it sold and then it came back down to this level, right? So for my people who will be getting in for a buy, right, you would get in around here, right, for a buy because you know the market is going to go up, and you will set your TP, right, or your take profit level somewhere up here, right? And then you will set your stop loss just a little bit below where we can see these wicks are. Now, this is going to be extremely important, so I hope you guys are taking notes. So we see if we would have went up, the market would have hit TP, right? It would have came down, went up, came down, went up, right? And we can see eventually, after staying in this pattern for too long, this candle, right, it broke out, which would have wiped out any of these people who were in for a sell, right? And remember, my people who got in for a buy down here, this candle also took out those people by creating a new low. So now we have a new level of liquidity that has formed right here. Now, keep watching what happens. So now, since all of these people have been taken out of the trade because this is where their stop loss were, people who are now in for a buy, this would be their new stop loss. But look at the very next candle. Those people would get stopped out. And then look at the very next candle. Those people would get stopped out. And as we can see, as we move and the market continues to develop, anybody who is placing their stop loss at the previous low will tend to get stopped out eventually in the future. What you need to understand about the market makers is that they will always come back and collect their money, because if they know anything about traders, they know that most people will have their take profit and stop loss at the very same area. So let's look at another example. This market has been choppy for a few days, so I'm going to look at it on a higher time frame to see if we can get some better examples up here. And I'm also going to turn off my session breaks, so everything's completely clear. So again, when we're looking for liquidity in the market, you're going to want to look for where you see these collection of wicks, right? You're going to want to look for, you see, okay, I see a rejection, right? At this level, I see a rejection at this level. I see a rejection at this level. This means that the market is probably going to end up going up sometime soon. The market will come back down. It'll go back up. It'll come back down. We have more rejections here, right? So anytime you see these wicks, just know that the market probably is going to turn around, right? Now, when it comes to setting your take profits and stop losses, you're going to want to always set them at the last previous high or the last previous low. And for example, let's look at what's happening right now. We can see that we had 1 rejection, 2 rejection, 3 rejections on the bottom, right, where the support area is. And then we can see that the market turned around. Now, where do you set your TP? Because I find a lot of people always get confused about this. You can set your TP here because this is where the last liquidity was at the top. And anyone who got in for a sell, they most likely set their stop loss here because it's above the previous high. Now, you're going to want to keep going if you're in for this buy. You're going to want your TP to be here, right? Because once we wipe out this high, it's going to be going for the next previous high, right? And I'll just scroll back and give you guys some past examples as well, because this is going to be consistently happening, right? This is going to be consistently happening because the market always has to fill in those gaps, and it always has to get back to a previous place that it was before. So here's an example of, let me get my pen. So here's an example of a sell, right? The first thing we're going to notice is that we have all of this liquidity here. So if someone were to get in for a sell here, they would set their take profit down here, right? Because it's at the previous low and the market's going to sell. You will set your take profit here, and you will set your stop loss a little bit above where these wicks are. And if we would have gotten in for this sell, we can see that the market actually would have hit our take profit point down here, but then eventually a new low would have been created, right? So anybody who had their stop loss here, you would have eventually gotten taken out of the market if you let it go past the previous low point, right? And again, this is going to be happening consistently. You'll notice that the market will always go just a little bit above or just a little bit below where the previous high or low was, so that it can take everybody else out of the market. It can collect all of that liquidity and extra money that was just sitting there, and then it will actually turn around and go the way that it wants to go. So I'll give one more example. And this is actually happening in real time here. We can see that we have some liquidity that was happening here. We can see that the market looks like it is about to turn around and go for a sell. And what we would want to do is we would want to set our stop loss a little bit above the last previous high. And we would want to set our take profit where you see other liquidity is, because if the market is making a move that is based on liquidity, then the next goal is to get back to a liquid area. So your TP could be somewhere down here because we're expecting the market to sell, come back down to a liquidity area, right? We want them to stop out these people and probably take profit around here, right? Right? So I hope that makes sense, guys. The best way to spot liquidity is to look for the wicks and to use your indicators. And I will try to look for an example. As we can see, this market has been choppy for some time, but I will try to look for an example where we have everything together. We have our liquidity, we have our EMAs, and we have our momentum all going in the same direction. So let me just turn my indicators back on so we can put everything together that we just learned. And hopefully you guys can use this to be better traders. So let's look at this example right here, right? Or we can even look right here. Either one will be fine, this entire area. So we see we have liquidity, we have liquidity, we have liquidity, we have liquidity. We have all of these wicks touching the same area. So that will be one indicator for a sell. The second thing that we have is the trend has been established. The trend is below average because both the candles, or all the candles, are falling under both the EMAs. That's two confirmations for a sell. The third thing we want to do is look at the momentum indicator and see if it is below 50. I mean, if it is below 0, which it is, we have 3 indications for a sell. We will set our stop loss a little bit above this area, or even right here for our stop loss. And we will set our take profit at the previous low, which was, we will set our take profit at the previous low, which we can't see on the chart right now, but we will set our take profit somewhere down here, right? And as we can see, it continued to drop and it passed this point and the market continued to go down. So that would be an example of using liquidity plus these indicators. And then we can also find a buy example as well. Remember, take sales below the EMAs, take buys above the EMAs. And this is a 5-minute chart. That's just why it's taking some time to scroll. And this market is actually trying to rally upwards. So you are going to notice a lot of consolidation. Okay, so here's a really good example for a buy. I know this can be a little confusing, but just watch this video a few times or look for other videos on liquidity, and I promise it'll make sense. So what do we have? We have liquidity sitting at the bottom, meaning that the market is going to push up eventually. So That's one indicator we have to get in for a buy. The second indicator is that we have the candles forming above both of the EMAs, which tell us that the trend is going up. So that's going to be our second indicator to get in for a buy. Third, if we were going to get in on this candle, we have the momentum indicator above 0, which is our third indication for a buy. And then we can see that the market went up. Now we would want to put our stop loss somewhere down here where there's previous liquidity, and you would want to set your TP a little bit higher than that. So if you find your stop loss first and your stop loss is 15, you may want to put your take profit at 15 as well. If you set your stop loss at 20, you may want to put your TP at 20 as well so that you can have an equal 1-to-1 risk to reward ratio. But yeah, it's pretty simple. Once you guys put all these things together, it can give you a little less anxiety about trading simply because now you know what you should be looking for. Again, the candles are forming above the EMAs right now currently, but we do have some liquidity at the top. So just really use your discretion, put everything together, test it out in your demo account, and just really start to see if this makes sense. I highly encourage you guys to back test your strategies, which just means going back in the past and seeing how many times has this actually happened. Don't take my word for it, right? Take your word for it and really practice.